the one big beautiful bill. Everybody's been talking about it, hearing about it, and I really don't care what your political affiliation is. The whole point of this bill was to make the Tax Cuts and Jobs Act, which was in 2017, which was right after he got elected the first time. It's to make those cuts permanent. Quick rundown: before 2017, the tax rates went 10, 15, 25, and then escalated from there. So now,
The Mark Biggs Show.
what's up, everyone? Welcome back to the Mark Biggs Show. Action-packed episode for you today regarding something that will affect each and every one of you, kind of regardless of what your situation is. First and foremost, I want to say thank you for being here. Take the time, if you don't care, if you haven't already, like, share, subscribe. Wherever you listen to podcasts at would mean a lot to me. Really appreciate that, and that's my only ask of you. I don't ask anything else. Just that you tune in, hopefully learn something that you can take with you day in and day out, and just be better. That's the whole goal of this thing. So if you do that for me, I greatly appreciate it. The one big beautiful bill. Everybody's been talking about it, hearing about it, and I really don't care what your political affiliation is. Doesn't matter. I just want to kind of go through some of the key points and provisions that I think will affect most people. There's some, specific things that will affect certain people, but just kind of wanted to go over what will affect the masses. And regardless, once again, of your political affiliation, which I completely do not care about, how it's going to affect you, and whether or not you agree with the administration, what they do, is kind of irrelevant to this point. So I'm a financial advisor, obviously, as most of you know. So taxes are a key part of any financial planning process, or at least we feel like it should be with our approach at Biggs Financial. But one big part of the tax situation is knowing certain things and how they affect you and your situation. So one of the key things that comes to mind first is the whole point of this bill was to make the Tax Cuts and Jobs Act, which was in 2017, which was right after he got elected the first time. It's to make those cuts permanent. So the whole idea at that point in time was that those changes that were made in 2017 were to expire in 2025 if nothing changed. So obviously, going into this election cycle, everyone knew that pays attention to taxes and that sort of thing, that taxes would be a key thing that was changed probably early on, regardless of which side won the election. So this bill makes those cuts permanent and has made a couple changes too. So number one, once again, this affects everyone. So whether or not you're a high income earner or a low income earner, really doesn't matter. They made permanent the tax rates themselves. So quick rundown: before 2017, the tax rates went 10, 15, 25, and then escalated from there. So now in 2017, they changed it, and now this makes it permanent. It's still 10% is the first rate, but then it jumps to 12, 22, and then 24. So most people in America, I would assume, find themselves in one of those tax brackets. So obviously, 2 or 3% of your income is not a huge deal. However, it is a tax saving. So every single person is saving a few percent on the first portions of their money. One thing that I want to share too is that most people don't know it's a progressive scale when it comes to taxes, meaning the first so many thousand is always taxed at 10, and then the next so many will always be taxed at that next bracket at 12, so on and so forth. So a lot of people ask me questions like, hey, when do I need to stop making money before I jump into this next tax bracket? And that answer is always make as much money as you can. Because even if you jump into a new tax bracket, it's only the dollars above that threshold that get taxed at the new rate. Example, if you jump into the 24% bracket, that doesn't make all of your income taxed at 24%. It only makes the dollars above the threshold taxed at 24. So without getting too far in the weeds there, everybody's going to save a little bit of money compared to what it was prior to 2017 with those new tax rates. So that's one thing that they made permanent. The second thing that they changed was children that are claimed on tax returns that are 16 and under used to have a child tax credit of $2,000. Now that credit is now $2,200. So for families that have children on their returns, they're going to get $2,200 per child instead of the $2,000 that it was prior to this bill being passed. So that's one thing that affects, I won't say everyone, but most people. Next, one of the big hot button issues with the Tax Cuts and Jobs Act that was kind of I don't know the best way to put it, but people that criticized the bill were kind of talking out of both sides of their mouth on this one. So the Tax Cuts and Jobs Act was proposed as a tax cut for the rich. But one of the ways that it actually hurt wealthy people was by limiting how much state and local taxes that you could take as a deduction. So anybody that knows, on a tax return, you can deduct your property taxes on your home, on your vehicles, and then like in the state of Kentucky, we have a state income tax. So you can deduct on the federal return the state income tax you paid the year prior. So long story short, that cap on how much you could claim was changed to $10,000. So without getting too political, a lot of the more Democratic-leaning states have higher tax rates, New York, California, etc. So people in those states have higher property taxes, they pay more state income tax, and they kind of got chopped at the knees with that cap. So they changed it this year to a $40,000 cap is the way that it sits now. So instead of being capped at $10,000 on what you can deduct, they've changed it to 40. That's a key thing that I think they got a lot of pushback on, even from people that criticize the bill, because that hurt a lot of people. So they changed that to 40. The standard deduction, meaning how much of your income is not taxed as a single head of household or married filing jointly taxpayer, doubled from what it was in 2016 and years prior. They made that permanent as well. So they adjust it for inflation every year, but a married couple gets to essentially exempt the first roughly $30,000 of their income. And that was made permanent with this one big, beautiful bill. Shifting gears to kind of business owner type things, they have brought back 100% depreciation. That's a fancy way of saying that if you buy an asset for your business, or in real estate, if you do a cost seg study and change the depreciation schedule of your rental property, you're allowed to write off those things 100% in year one. With the previous bill in place, the bonus depreciation started to decrease by 20% year over year. I think before it changed this year, it was down to like 60%, meaning if you bought a truck and you're a contractor or something, you can only write off 60% of that truck in year one. They've brought back 100% bonus depreciation, which I think will spur the economy, because a lot of people meet with their accountants in the third and fourth quarter of the year, figure out that they may need some tax breaks, they need some equipment anyways, so let's go buy it before the end of the year for tax savings. That allows them to expense 100% of that equipment, the vehicle, etc., whatever the asset is. Certain limitations apply, of course, but it allows them to write off 100% of it if they so choose. So that's a couple of the key provisions that I think affect most people. Tax rates being lower from what they were to 2016 and prior. Your child tax credit increasing from $2,000 per kid to $2,200 per kid. 100% bonus depreciation coming back. The SALT deduction is what it's called, state and local taxes, that got increased. And a couple other key provisions that I think were hot button issues going into it. Social Security, tips, and overtime were three big areas of income that they were trying to get passed to where there was no tax on them. So we'll start with Social Security. They didn't get it passed to where Social Security was completely not taxed, but what they did do was add an extra deduction for seniors. I want to say the threshold is 65 and over. You get an extra $6,000 in deduction, which is kind of designed in their minds to help offset some of your Social Security income if it applies on your return. Tips, they made it to where up to $25,000 in a calendar year of tips, you don't have to include on your tax return, so they're tax-free, so to speak. And overtime was similar. However, overtime, the limit was $12,500. So if you earn overtime at your job, you can exempt up to $12,500 of that from your taxable income on your return. That's going to come with some additional reporting for accountants and people that make W-2s, et cetera, but that's all up for the IRS to decide. But at the end of the day, they didn't get no Social Security passed in full. Tips, they got to where you can exempt up to $25,000, and then overtime is $12,500. So that is a win for, a lot of hardworking middle-class Americans there that work overtime jobs, earn tips as a server or whatever the case may be. So a lot of positive things for a lot of people in our country. So however they want to spin it politically is up for you to determine and debate yourself. But there's a lot of things, in my opinion, that will help everyday working class, middle America to save more money from the government, keep the government out of your pocket, so to speak. We always say at Biggs Financial, we're trying to keep two people out of your pocket, and that's Uncle Sam and Wall Street. And so that's, I think this bill aligns with that pretty well as far as the Uncle Sam aspect of it goes. So a lot of people have been talking about the one big, beautiful bill. So I wanted to bring you a little bit of a synopsis for the things that apply to most Americans. Like I said, there's the bill. I don't know how many pages it is, but it applies to a lot of different specific things. But these are a few of the provisions that apply to most, if not every single American. So hope you take something from that, and I hope this helps you as you're going into the end of the year. Maybe do some planning, talk with your accountant, talk with your advisor, see how it's going to affect your situation. But I wanted to give you an idea of kind of some key things that apply to most people. So thank you for tuning in. And once again, I'll ask if you will like, share, follow, and subscribe, YouTube, Spotify, Apple Music, wherever it is you listen to it. I thank you for tuning in, and hopefully I continue to add value to you, and we'll see you next time.